Greetings, everyone. This is Cathie Wood, CEO and CIO of ARK Invest. It is Employment Friday, but there's no employment report. We will have that next week. But given all of the fireworks in the market and all the drama recently, I felt it was important to do In the Know, or at least on the In the Know Part 1 today, just to address the three topics that we think have really unnerved the markets: AI hype, crypto meltdown, and macro statistics, but more macro variables like Fed speak. So let's go through each one of those, and we'll start with the AI hype. So you can see from this first chart here what our predictions in December of 2024 were for really the tech stack as AI was evolving. And you can see here that we saw rapid growth in all three areas of the tech stack. So the infrastructure layer, the platform layer, and the application layer. That was true in the 4 years ended, or 5 years ended 24, and our expectations for the next 5 to 6 years. Now, what we also pointed out below is that there were share shifts taking place in terms of incremental growth among these three. And you can see that the big winner was platform as a service. Think Palantir, one of the most important companies in this AI revolution. And its growth rate, U.S. commercial alone, last quarter was 142% in revenue growth. No other software company is coming close to that, at least in the public equity markets. In the private markets, of course, you've got the frontier model players running away with 250 to 850% growth rates. Think OpenAI and Anthropic in the last year and a half annualized. You can see the big loser we thought was going to be the application layer, largely software as a service. Now, if there's something wrong with this chart, you can see it is in our projection for software as a service going forward on the top there. 20% plus. It's not going to be anything like that. In fact, we do believe that software as a service is becoming a victim of this AI revolution. There will be consolidators and software as a service providers who do survive this route. They will consolidate the market. But we underestimated ourselves. We were saying that SaaS was going to lose share. We didn't realize how much, how soon. And that gives you a sense of how quickly this revolution is happening. 142% for Palantir, U.S. commercial, in 1 quarter. We didn't expect that either. In fact, our CAGR, our compound annual rate of revenue growth assumption, which we thought was enormous at the time, for the next 5 years for Palantir itself, is 55%. That could be wrong too. Maybe it's too low. So here we are. Okay, next, what about all of these capital spending announcements from the hyperscalers especially? This is unnerving. The Mag 6 or investors holding the Mag 6. These investors, many of them benchmark sensitive. What does that mean for people who don't understand what that means? The market, since the tech and telecom bust, and so that was the early 2000s, and the 08-09 meltdown, has become much more quantitatively driven, which means that many portfolios are guided heavily by the indexes out there. Now, to give you a sense of that, Amazon and NVIDIA in the NASDAQ 100 are in the 3 to 4% range in terms of the holdings. And what benchmark sensitivity means is portfolio managers will say, okay, I am betting against, let's just say NVIDIA for argument's sake. NVIDIA, I think, is at a 3.4% position in the NASDAQ 100. And so those portfolio managers will take their position down from maybe they were optimistic on NVIDIA and they were at 3.8. Well, they'll take it down to 3. And to them, that's betting against NVIDIA. And to them, that's also taking a big risk because they're being compared against other managers who are doing much the same thing. As you know, ARK Invest doesn't think that way at all. We are focused on the future, and we're very focused on pure plays. We do hold both NVIDIA and Meta in our funds, but for the most part, certainly in our flagship strategy, we're well below that weight, well below, in the 1 to 1.5% range. Just to give you an example of how portfolio management has evolved over the years in the traditional asset management world. So I think that the shareholder base holding the Mag 6, they have gotten so used to cash hoards and massive free cash flow generation that this is a big shock to them, seeing these hyperscalers take their capital spending budgets up 100% in 1 year. I think Amazon announced it would go from roughly $90 billion to $180 billion next year, or this year, 2026. That's shocking to people. And we're seeing some of the Mag 6 raising debt even. That has been anathema to this group. So we do think we're seeing a shareholder turnover, not massive because of what I just described about benchmarks. But we don't think necessarily that they are doing the wrong things, meaning the hyperscalers. We think Google is doing the right thing. And all of the Amazon, all of the spending we think is the right thing to do. But this is not what traditional portfolio managers who are benchmark sensitive are used to grappling with. We grapple with it all the time. But here you can see what we put in our Big Ideas 2026. You can see, and what we're trying to illustrate here is investment in data center systems. Now, I know you've probably seen the $650 billion capital spending boom that newspapers are highlighting. That includes much more than data center systems. So just want to make that clear. So you can see here that data center system spending growth was really mid-single digits at an annualized rate for many years, and it kind of stayed in the $100 to $200 billion range until the ChatGPT moment. And since then, you've seen a compound annual rate of growth at 29%. I think with the announcements today, 100% in 1 year, we're moving into overdrive. Now, you can see from our forecast that we've been expecting a 30% compound annual rate of increases since 23. And I think if we were to push this forward to 25 now and do a 5-year CAGR, it would be in the 25% range. So these recent announcements certainly are proving this forecast right. And then you can see, just to throw in another perspective here, we also see that the chip market is going to transform or evolve, I should say, in the next 5 years, a little bit from GPUs taking share to ASICs taking share. And so we've highlighted that there could be a shift from the likes of NVIDIA's chips, AMD's chips, to Broadcom's chips. Now, we think that there's going to be a massive appetite for all chips, but did want to highlight this share shift as well, much like we highlighted the shift away from SaaS toward platform as a service. Now, this spending, is it justified? This chart, Brett Winton, our chief futurist, prepared for Big Ideas 2026. It highlights the technology revolution investment cycles here. And you can see the railroad in the 1800s. Railroad spending, as capital spending as a percent of GDP, got into that 5 to 6% range. Then you go to the automobile in red there, but we have multiple platforms evolving at the same time, and this is additive. So maybe with telephone, electricity, and the automobile, we would see capital spending up at that, cumulatively, up at that 5 to 6% range. And then you get to the internet, the tech and telecom boom, and you can see it looks like it pales in comparison to those other two, but we do have an additive situation going on here, and you can see that adding all of those together is maybe the equivalent of just the automobile cycle in the early 1900s. And then here we are, and we believe these are our forecasts, and they have been our forecasts, and we haven't changed our forecast in the last year. But we've got something additive going on here as well that could accumulate to 12% or more of GDP. Now, just to give you a sense of or some perspective, I remember in the bubble, telecom equipment spending on the part of some providers got up to 25% of GDP. And as I always say, too much, too soon, and we ended up with a lot of dark fiber. It didn't go live for a very long time. One thing we can say about this cycle is the demand for GPUs is voracious, and they are landing in these data centers, which are saying, we need more capacity. We need more chips. Those GPUs are not dark. And I'm stealing that from Brad Gerstner at Altimeter. I thought that was a very good analogy. The fiber went dark. GPUs are alive. And there's a big scramble for them. Now, the risk here is, and, I have an economics background, and I'm always looking for those risks. Whenever I hear the word shortage, I usually believe that there's going to be a glut, an inventory glut at some point. And I'm sure there will be in the chip space, but I don't think it's going to be for a long time. You need to listen to Elon Musk, who's talking about chips and power as, for as far as the eye can see, being in short supply. And now that he's thinking about putting data centers into space, perhaps even more so. So on this next chart, this is getting to investors. So you can see on the left here the tech sector capital spending as a percent of GDP. And you can see that it has gotten up to bubble days. And that's a little bit unnerving to investors. And here's why. Many of the most seasoned investors today were very young when the tech and telecom bubble took off. And now they are the gray hairs. And I'm friends with a lot of them. And many of them are saying, been there, done that. I'm leading this organization now, and I'm going to protect it from this bubble. And we understand that. But as I just described, we have really just started this journey, and we expect the capital spending cycle to go much further for much longer. And the reason is the technologies are ready. Back in the 90s, we didn't get the cloud even until 2006. But there were visions of, eyeballs in 10 years being the source of valuation today. We didn't get the cloud or back then. We didn't get the cloud until 2006. We didn't get the first big breakthrough in AI until deep learning, ImageNet, in 2012. Even bigger and more profound, transformer architecture in 2017. And even off of that, we didn't get ChatGPT, the aha moment, until the end of 22, early 23. So we have just begun this journey. Now, one other difference, very important you can see from this chart, is the valuations today are much different than they were at the peak of the bubble. So the dashed line there, you can see is the valuation of the Mag 6. And you can see how crazy the valuations did get at a time when the technologies weren't ready and the costs were too high. So the multiples being paid today are nothing like back then. And in fact, since this chart was done, the multiples have dropped even lower because it is the Mag 6 and fears around what are they doing with all of this capital spending. Return on invested capital is going to go down. That's why I own this stock. And that's why a lot of quants or quantitative research is a little bit, I would say a little dangerous here because a lot of it's momentum driven. And here we are, there's a great disruption taking place called AI. And these companies must invest in it if they want to remain relevant, and they must seize the moment. But short-term oriented shareholders don't really want to hear that. So on this next chart, we're heading into crypto. And we'll loop back to AI at the very end. Crypto, here I think the disconnect, and this is also from Big Ideas, is, hey, look at what the gold price has done in the last few years, and look at what's happened to Bitcoin. Now, this is a log chart, so you can see gold has had a massive move to the upside. This chart ends at the end of 25, and of course, I think last night we got down to roughly $60,000 in Bitcoin. So really cut in half since its peak in October. What is going on here? Isn't Bitcoin supposed to be digital gold? If it's digital gold, why isn't it behaving like gold? And a couple of points to make here. If you do the correlation between Bitcoin and gold, their returns, since 2019, and I put this in my New Year's letter. You can see the matrix there if you'd like. The correlation has been 0.14 One is perfect correlation. And here we are at 0.14, very low, almost no correlation. So that is very important to understand. What you can also see here, though, is gold tends to precede a big move in Bitcoin. You can see the circles there, and we'd have a gigantic circle around what has happened recently. And so maybe that will happen again. We actually think it will. I cannot tell you how many bear stories I've heard about Bitcoin in the last few weeks, last few months. And just go on to X and you'll find all kinds of reasons why you must sell Bitcoin. And these are the periods that are kind of interesting. We post our trading at the end of every day, and you'll see that we had been nibbling at our crypto-exposed stocks. We didn't know how far this was going to go. And maybe it's not over, not promising that. But there was so much negative sentiment that I felt, okay, we need to leg in and lean into this. If our research is correct, that this Bitcoin is 3 revolutions in one. It's a global, digital, private, very important, rules-based, even more important, monetary system. And that's a very big idea. The second revolution is a technology. It's a new technology. It's really adding another layer, I would say, to the internet, so that we have native currencies native to the internet that will be able to handle agentic commerce and other such agentic movements taking place out there. That's a very big idea. And then, and it won't be, of course, just Bitcoin. It'll be Ether, importantly Ether, Solana, maybe Hyperliquid. We shall see. But what's interesting about this period is the big 3 have been identified. And those are Bitcoin, Ether, and Solana. The worry historically has been, how many of these things are there going to be? Is this going to be a very fragmented situation? And we're learning we're learning who the big winners are going to be, who the big winners are. And I think that's a very important. And then the third revolution is, this is a new asset class. Bitcoin is leading the way. It is the most secure of all the crypto currencies out there, backed by the largest computer network in the world. And so really an anchor to an asset allocator looking to move into this new world. And why would an asset allocator do that? Well, if we're right, and well, it's a fact that at least over the last 5 years, the correlations have been the correlation has been as low as 0.14. The key to successful diversification for asset allocators is adding new assets with very low correlation to all of the other assets in the ecosystem. And this one qualifies. Why do they want that? It is because with that low correlation, introducing it, risk-adjusted returns go up over time. And so I do think institutions are serious about this new asset class. They may have been reticent to move in because they were hearing about the 4-year cycle, and lo and behold, and I'll hats off to Chris Berniski, who has been very right in calling for, whether it's the 4-year cycle or whatever, just this downdraft. And so it's closing in on the low point that many technical analysts are suggesting as the place where it should stop. These are very volatile moments at or near the bottom, but we usually do look back and say, wow, I wish I had caught that low. This V-shaped recovery has been quite significant. Not promising. I want to make sure that there are no promises here, but it does seem like the stars are aligning. I guess I'll move on to the next one. So what has been the biggest bugaboo as it relates to Bitcoin, or the worry that we've heard about more than anything else in the last few weeks? Because it's all about quantum computing. The last few weeks have been, lots of stories about quantum computing, and I would say the large shift in Bitcoin, the OGs selling, or just shifting wallets to more quantum-resistant wallets. So I think that's really caused a lot of concern. And here's Michael Saylor's answer, he was very reasonable last night in his discussion around quantum. He doesn't think it's going to be an issue for 10 years or more, but he said, here's what we're doing in terms of our commitment to Bitcoin security. And so you can see some of those moves now. But I also wanted to show our research. Again, this is out of Big Ideas. And this is when the quantum controversy had quieted down last year as it relates to Bitcoin. So Brett Winton, as chief futurist, has a big focus on quantum, because we can't miss the next big thing. It's all we do is disruptive innovation. And here I thought was a compelling analysis based on what has happened with quantum computing so far. And Google really leading the charge, that little black line on that chart. So you can see that it has been able to double the number of qubits over 4 years, which is slower than Moore's law in the semiconductor space. And of course, there is an error rate consideration, lowering that as well over 4 years. So if Google does not pick up speed, the red line tells you how long it will take Google and quantum computing to really threaten Bitcoin, the Bitcoin blockchain as we know it now. So we go into the 2060s there. Now, if you make the assumption that Google is going to pick up the pace, and that's an interesting assumption, because typically we learn a lot in the early years of a new technology. How quickly are the units increasing and driving costs down? That's the learning curve associated with new technologies. But let's assume it does pick up the pace, doubles the pace to Moore's law. Okay, then we have a problem in the mid-40s. So I don't want to make light of it. I do think it has caused movement of Bitcoin between wallets, between and among wallets. Are they leaving the crypto ecosystem? Some say yes. Maybe they're diversifying into other crypto assets as the DeFi ecosystem evolves here. I don't know how likely that is, because these are Bitcoin OGs. They've been there forever. So we'll see. Maybe they're diversifying because they were hodlers, and now they're 10, 15 years older, and they have families and their risk profiles have gone down. They should diversify. Any financial advisor would say so. We'll find out, but I thought Brett added some good perspective here. Now, going into economics, and again, I'll whip through this last part because I'll do a more in-depth in the know next week when the employment numbers do come out. So here you can see the liquidity index. This is Dan Rodriguez's chart, and you'll see liquidity dropped to a low level in November. Why was that? It was the government shutdown. And we thought, okay, this is going to be short term. Liquidity will pick back up and the market will take off again. And that is what happened. But recently you can see that it is back down. And what's happening there? Well, we had the threat of the shutdown, and now we actually have the shutdown, partial shutdown. And in mid-February, I think it might be February 14th, there's going to be a vote around the Department of Homeland Security's budgeting, and it may shut down more completely then. So I do think there is somewhat of a liquidity drain. And then the other thing that's happening is the Fed was supposed to stop quantitative tightening in early December, and it did for the most part. But its provision of liquidity to the system is lower than many analysts expected. In recent days, it has started to pick up. You're seeing some of that now. And I do think the Fed and the Treasury are beginning to respond to what has happened to the financial markets. This administration does believe that the financial markets provide important signals. And so they are probably assessing the liquidity conditions out there and moving accordingly. So I do think this one is probably moving in the other direction. Here you go. You've seen this chart many times, metals to gold. We've learned something very important, and I'll spend more time on this in next week. But what surprised me, and this is up to date, is with the fall off in gold recently, that the metals to gold ratio has not picked up. That is really surprising to us. We've learned in recent weeks why the Treasury yield has been levitated. This very tight correlation between the metals to gold ratio and the Treasury yield broke down starting with the Fed tightening. And, it's still gaping wide. We're learning and believing more and more that this is the yen carry trade unwind. What are they doing? Selling treasuries and buying Japanese bonds. Why? Because Japanese interest rates have gone up. And so the U.S. Treasury bill is less of a less interesting. It's still above the short-term rates in Japan, but less so, much less so actually, and could continue in that direction if the current prime minister is she just called a snap election. I think it's for this weekend. And if she gets a larger majority, she will amp fiscal spending even higher, and that will probably take their interest rates higher. Nonetheless, the purple side is puzzling. I think it has to do with deflation coming out of China and impacting the global ecosystem. Sure, we've seen some metals go up, but this ratio going down even further as gold goes down is most surprising. Here, I just want to go through, I presented this chart at the last In the Know, so we'll just give you a sense of how crazy it got a couple of weeks ago, gold going parabolic. as a percent of M2, and many people pushed back on our use of U.S. M2, you can't get global M2 back into the 20s, and the U.S. still is the reserve currency. I don't think the message would be much different with a global M2. So you can see it hit an all-time high, higher than the Great Depression, at 1.6 versus 1.76 versus 1.71 in the Great Depression in the 20s. Today, it's at 1.54. So we do think the bloom is off the rose, but it's still at very extended levels. And we wouldn't be surprised if gold continued to come down to Bitcoin's benefit. We shall see. And also, I think Bitcoin has been hurt by all of the funds flowing into AI. That became the interesting investment opportunity, and that one has become a little shaky. So I think, these three, gold, AI, and Bitcoin, are interrelated in that way. Now, gold as a hedge against inflation. Look what Trueflation is telling us. It's telling us inflation is resolving to the downside. It is not moving up. And there are a few things going on. Gasoline prices, until very recently maybe. Housing prices, and that's going to continue as rents come down. And even potato chips, Pepsi, Frito-Lay, Doritos, cutting prices 15%. And hims and hers, although the FTC, I think the FTC is going after them, cutting the price of GLP-1s to $49, whereas I think Novo Nordisk has cut its entry price or introductory price to $149, and then it's going to move them up to $199. This is deflation. This is deflation. And we're going to see a lot more of it, we believe. Unemployment rate. And, of course, all of this is trying to figure out, okay, what's the Fed going to say next? I was very surprised that Federal Reserve Governor Bostic said employment is very strong. And he's looking at the overall unemployment rate. And when you have 1.3 million baby boomers leaving per year, the overall unemployment rate is probably going to stay fairly low. And we've also got immigrants who are exiting, and we don't have as much of an inflow of immigrants. So the unemployment rate is going to stay low overall. But you can see what's happening to the 16 to 24-year-olds. Their unemployment rate has gone up from roughly 7% to more than 10%. The last time I presented this, it was 12.2%, but I think there were downward revisions, and we'll get to the bottom of that. But still, 10%, and the duration of employment almost a half a year. So I do think that the concern about employment will build as more and more Fed governors understand entry-level jobs are disappearing. And so a very important demographic is not getting jobs. We do think that's going to change as a lot of these young people go out there and go for it in terms of starting their own businesses, because the barrier to innovation, the barrier to starting new businesses is dropping precipitously with AI. I'm just going to end on two charts. Once again, we're very optimistic about GDP growth. We think we're going into a productivity-driven boom. And just reminder, the step function change in GDP growth when we had the last big technology revolution, which was the early 1900s, that growth rate stepped up from 0.6 to 3%, fivefold. And we're saying 7 to 8% by the end of the decade. So I think that's conservative, given given the technology revolution underway. And finally, this is how we think that innovation is going to play out in the equity markets, the market cap. On the right-hand side there, you can see what happened to railroad stocks as a percent of the total global equity market cap, 65%. You can see where we are now, and we think this revolution is even bigger, as I mentioned, and really just starting in its first few years at least. And you can see where we think innovation is going to go as a percent of global market cap. Again, we've just begun. We don't think AI hype is where we are at all. We do not think we're in the equivalent of the tech and telecom bubble. We're very happy that many people are worried about it. In the tech and telecom bubble, nobody was worried about anything. In fact, I'll remember clearly Jeff Bezos at Amazon, and I think this was in 1999. He, with some glee, announced on Amazon's earnings call that Amazon was going to lose so much more money in the next year because Amazon, Jeff, had decided this opportunity was so much bigger than anyone understood. And by the way, he was right. It was going to take much longer. That he had to up the capital spending budget. And what happened that day? The stock just soared. And one of our panelists on our brainstorm this week reminded me that a journalist asked Jeff, well, how do you spell profit in this new world? What does that mean? And he spelled it P-R-O-P-H-E-T. So that's how cavalier CEOs of innovation-based companies were back then, those driving the innovation. And then, of course, they paid a heavy price for that over the next 3 to 4 years. The fear in the market today, when I see Microsoft going down 12% because it's doubling its capital spending over the next year, or Amazon going down 8, 9, 10% because it's doubling its capital spending over the next year. Completely different response, completely different investor mindset. I think there's real fear out there. That was one of the reasons gold went up, fear of everything. And I just think, and this is why I wanted to do the call today, I just think we're in a completely different era, no resemblance to the late 90s. I was there. And I think we're in for very exciting times. And don't underestimate the growth rates that these new technologies are going to spur. We think they're going to be super exponential growth rates, and Palantir is a very good example of that. No one expects the 142% U.S. commercial revenue growth to be sustained. We don't either. But, if it were able to sustain, 70, 80%, which is higher than what we have in our model, that stock would be a screaming buy today. So we are assessing all of this as everyone else is in the financial world. It's a really exciting time. It's a confusing time. There's going to be a lot of chaos. You saw a lot of auto manufacturers basically shutting down their EV efforts. They couldn't scale them quickly enough to capture the cost declines. They're giving up. And one of the most interesting ideas I heard on our brainstorm today was the idea that, well, who's going to roll the auto sector up? Normally you think it'd be an auto company, one of the big ones. Someone suggested, no, maybe it's Google. They need cars. So with that, I know we have a relief rally today, Friday, and no one knows what the future really holds. But I just wanted to be in front of everybody because I know how harrowing it must have felt over the last week, and just wanted to reinforce our point of view because we think a lot of the data that has come out recently does just that. So I'll see you next week.